And Ron, nice to have you with us this morning. Let me just start off with your business and what you're seeing from your clients right now in terms of their sentiment.
Well, first of all, our business on the transaction side is frankly quite robust, as you might imagine. I've been also quite impressed and proud of my staff that has been able to do this with 70 to 80% of the people working remotely, which, by the way, to Jim's point earlier, that is a big thing that people need to think about. Businesses are learning about working in the cloud, and there's going to be some winners out of this from how businesses operate going forward. But business has been good, and now let's see what happens in the second quarter. Our investment banking business clearly is being impacted by this.
Yeah, I wouldn't expect, as we know, there's not going to be too much. But what are you seeing in terms of clients? What is sort of the overriding? Are they sticking with it? Are they all running to cash?
Yeah,
and then we've had some dislocations, Ron, too, and sort of things like money markets and corporate bond funds that certainly can be confidence killing.
Yes, but this decline in the market happened so fast and so suddenly and was so precipitous that many clients now are sitting there and looking at it, as they should, and saying, is it now down 20% from here, or is the more likely upside? And so I think clients have been surprisingly calm. Maybe they have to be. I'm supposedly an expert, and I watched my own portfolio drop precipitously, saying, why didn't I sell? But of course I know better, and our clients know better. So I think that's been surprisingly calm. In terms of money markets and all that, look, the Fed has done a remarkable job of making sure there's liquidity in the system. And when you look at what the Fed has done, you can go back to the old adage as don't fight the Fed.
Yeah, I'm so glad you pointed that out, Ron. I actually think that everyone's acted very responsibly in government. I thought that the bipartisan bill out of Congress, I mean, come on, that's not so bad. And the Fed has been completely on the case. That the one thing that hasn't been on the case is COVID-19. I mean, this is a relentless enemy that's unseen, that you can't tell whether you've got it or not. We need to test far more. Obviously, if we get it, it's not a common cold or flu. It's ventilator. We don't know if we have enough of these. But don't we have to solve some of these healthcare issues before we feel like doing anything other than ordering on Amazon?
Well, it is a healthcare crisis, and of course we have to solve that issue. I do want to make something you should, ask your economist about, Jim, that come on after me. But everyone's talking about the decline in GDP. We just passed a $2 trillion bill. To me, it looks like $1 trillion of it's direct payments, and now I don't know how that flows through to GDP. When I went to school, government spending counted to GDP, and so there is a significant stimulus package that's in place here. If GDP is down 25%, that's $1.5 trillion, and we're adding $1 trillion in direct payments. Let's not lose sight of the economic impact of that. With respect to this virus, I think the real question that everyone dances around is at what point and what data will be necessary for the government to conclude that the so-called quarantine can come to an end, because I don't think there's anyone that believes that we will lock down this economy until COVID-19 is eradicated. That's not the case. The question will be, what is the data that will allow the cost of fighting this disease, which is shutting down the economy, when can that begin to abate? And, I wish I knew the answer to that, because I'd have a much better viewpoint of market performance from here if I had an idea of what that date was.